backed and powered by 150 years of business experience. Venue is a virtual data room trusted by the best of the Fortune 500 to move deals seamlessly from one to the other to the next too.
There have been many factors impacting retail over the last several years, such as e-commerce, the decline of the enclosed shopping mall, and competition from discounters and fast fashion. A challenging retail landscape is best demonstrated by the number of bankruptcy filings in the space, most notably by Radio Shack. In light of the challenges facing the retail market, what can we expect in terms of deal making, valuations, and financing? Welcome to today's second installment of Merger Talk. My name is Mark Aiello, Vice President General Manager for Venue, the virtual data room of R.R. Donnelley. Today I'm joined by Cathy Leonhardt, Managing Director and Co-Head of Peter J. Solomon Company's Global Retail Group. Cathy, thanks for joining.
Thanks for having me, Mark.
So the first question I have for you today is, what are the current sector multiples and where do you expect to see them headed?
Well, the stock market continues to hit these record highs, which I believe is indicative of valuation. Now today the market's headed south, but let's step aside to that. But most retail sector stocks are trading within 10% of their 52-week high. As we look at the retail sector, it is clearly a case of have and have not. So you have sectors where the multiples are well into the double-digit EBITDA. Then you have retail sectors and companies such as specialty apparel retail. I noticed you mentioned that in your opening line, some of these bankruptcies, but some of the specialty sector stocks are trading in the low single digits. So it is clearly a case of have and have nots. Now, notwithstanding all of that, with the market liquidity, stocks are trading at a premium.
And how are these multiples affecting deal value and where are they offering opportunities?
Despite the market liquidity, there are limitations on what buyers of any type will pay for these assets. So generally, this environment of what I would call high valuation levels are limiting M&A activity. But what is very clear is must-have assets are commanding very high premiums. We talked about double-digit enterprise value to EBITDA multiples. We're seeing transactions get completed at, teens enterprise value to EBITDA multiples for those types of assets. Now, there's an interesting theme that we're seeing that I think directly answers your question, which is there is a widening gap between IPO multiples and the multiples are being afforded to companies in a private M&A transaction. And what does that mean? That means sellers are more and more compelled to take their businesses public than to sell them because just the valuations are so compelling. So in turn, that limits M&A activity because if the sellers can take it public for such a significant premium to the price they'd be able to sell at in the private market, then we're seeing that activity stronger than the M&A activity in many cases.
I see. And in terms of the structure of M&A deals, have you seen things change significantly since the financial crisis?
There's not been a significant change in how deals are structured. I think if you look back to 2007, there was a significant amount of liquidity in the market and availability of financing. We're seeing that again today. That's really not different. I think if you look at leverage levels, we see leverage levels in LBO deals approaching that of 2007. So that's much the same. There's one structural comment that I would make that is somewhat different. It's fairly technical, but as it relates to PE deals, pre-2007 money was easy to come by. When we went into the crisis thereafter, what you saw were challenges of banks keeping their commitments to fund the transaction. And so what you saw was really, the structure of the risk allocation has changed in these deals, and you've seen a rise of what you call reverse breakup fees in deals. And there's a significant sophistication and development of the language around these terms in a transaction, and the reverse termination fees have gone way up. So that's sort of a nuance to what we're seeing in terms of deal structure. And the other thing that's happened, though, is the regulators imposing these caps on leverage buyouts to protect their Tier 1 capital structure, the bank's Tier 1 capital structures. That's going to be an interesting trend to watch as well.
Are there fundamental differences in how sponsors approach the market versus strategic players?
No, I wouldn't say a fundamental difference. We see sponsors as significantly competitive to strategic acquirers, and going back to this valuation gap between IPOs and private transactions, if sponsors see an IPO as an exit, it makes them more aggressive and i.e. pay a higher multiple in the transaction because they see they can exit at a higher valuation, and it makes them even more competitive with strategic buyers.
Cathy, thank you so much for joining today.
Thank you for having me.
For more merger talk, visit thedeal.com.